In 1637, a single flower bulb sold for more than a luxury canal house in Amsterdam, more than a master craftsman earned in 10 years, more than the annual income of a skilled merchant. It was a tulip, just a tulip. And when the market collapsed, it took an entire economy with it. The year is 1634. Holland is the wealthiest nation on earth. The Dutch Golden Age is in full swing. Amsterdam is the world's financial capital. The Dutch East India Company, the most powerful corporation ever created, is generating returns that seem almost supernatural. And into this atmosphere of extraordinary wealth and optimism arrives the tulip. Imported from the Ottoman Empire just decades earlier, tulips were exotic, rare, and beautiful. The wealthy displayed them as symbols of status. But then something changed. A fungal virus began infecting tulip bulbs, creating spectacular flame-like color patterns on the petals. These broken bulbs became the most sought-after objects in Holland, and prices began to rise. By February 1637, tulip futures contracts were trading on the Amsterdam Stock Exchange. People were buying bulbs they had never seen for prices they could never actually afford. Here's the psychology that drove the mania and why it is still running today. Nobody was buying tulips because they loved flowers. They were buying because prices were going up. And when prices go up, more people buy. And when more people buy, prices go up further. This is called a reflexive feedback loop, and it is the engine of every speculative bubble in history. Farmers sold land to buy bulbs, merchants liquidated businesses, ordinary citizens pawned household possessions. At the peak, a single Semper Augustus tulip bulb, the rarest variety, sold for 10,000 guilders. A skilled craftsman earned 300 guilders a year. The tulip was worth 33 years of skilled labor for a flower that would wilt in a week. Then, on a single February morning in 1637, nobody showed up to buy, and the entire market collapsed overnight. Tea began in Harlem, a routine tulip auction where buyers simply didn't appear. Word spread within hours. Sellers panicked, prices dropped, more sellers panicked. Prices dropped further. Within days, tulip bulbs were worth less than onions. The contracts, promises to buy bulbs at future prices, became worthless paper overnight. Fortunes that had taken generations to build, gone in a week. The Dutch government attempted to intervene, declaring contracts void, offering settlements at 10% of face value, but the damage was done. And here is what most history books miss. The tulip mania didn't just destroy individual wealth, it revealed something fundamental about human psychology that no amount of intelligence or education has ever managed to fix. Because the tulip bubble has happened again and again and again with different assets, different names, different centuries, but exactly the same psychology. The South Sea Bubble, 1720, the Railway Mania, 1840s, the dot-com crash, 2000, the U.S. housing market, 2008, cryptocurrency, 2017, 2021, NFTs, 2021. Every single one follows the same pattern. A new asset, rising prices, fear of missing out, borrowed money entering the market, prices disconnecting from any rational value. Then, a single moment where the music stops. The tulip mania of 1637 was not caused by greed or stupidity. It was caused by rational people. making individually reasonable decisions inside a system that had become collectively insane. That is the most dangerous kind of bubble because you can be entirely logical and still be wrong. The tulip is long gone. The canal houses of Amsterdam still stand, but the pattern it revealed has never left. Every generation believes it is smarter than the last. Every bubble feels different from the inside, and every collapse feels like a surprise. Subscribe if this changed how you see markets, because the next episode goes deeper into the financial patterns that repeat, whether we learn from them or not.